Welcome to Between Data and Risk podcast. Today we'll be talking about private equity investments in the lower middle and middle market businesses. Our guest will be Joe MacIsaac, operating partner at WoodLake Group, a private investment firm with a focus on this specific sector. Stay tuned.
If you're a business owner or senior manager, you probably had more than enough about all the wonderful opportunities awaiting you in the era of digitalization.
Whether it is big data, cloud, data science, or whatever buzzword is currently trendy.
If you would like to hear someone dissecting these claims and showing you what it actually takes to improve business processes, you're in the right place.
This is Between Data and Risk, where we discuss real-life examples of what works and what doesn't in the world of business operations.
Hi, I'm your friendly neighborhood data guy, Dr. Marian, and with me is my co-host, Artur Cognition Shared Solutions Chief Risk and Strategy Officer.
Hello.
Welcome to this episode of Between Data and Risk. Today we'll be talking about operational scalability and due diligence in the context of private equity, and we're excited to have with us today our guest, Joe MacIsaac, operating partner at WoodLake Group, President and CEO with extensive private equity experience, who agreed to share his experience with us. Hello, Joe.
Good morning, good afternoon. How are you?
Yes, we are absolutely thrilled to have you here. We can't wait to listen about private equity and operations from someone with your experience.
We've touched a bit about private equity in some of the previous episodes, so it's a topic which kind of comes in, and we've had some questions from listeners because it's kind of sometimes seen as getting funding from private equity. There's a bit of mystery around it, right? So let's kind of first give our listeners a very clear view of what we mean by private equity.
Certainly. The private equity industry is really not one thing. There are some very sophisticated, multi-billion-dollar investors that invest in huge companies, make big commitments of hundreds of millions, if not billions of dollars for individual companies. There also is middle market and even lower middle market. Lower middle market might be an acquisition as low where the total price could be $10 million. So that would be the entire enterprise value of a company. So between $10 million and in the multiple of billions of dollars, there's huge discrepancies as to what the meaning is. So typically it's just where there's a controlling investment where a private equity group or a group of partners, oftentimes more than one investor, makes a controlling investment in a company. Could be a family-owned business, could be another private equity-owned business, and it could be in really any industry, industrial, software, distribution.
And when you say controlling, what do you mean by controlling parties?
Well, that's a good question. Where they own more than 50% of the equity interests, so that they have control of the board of directors and control over the investment, so that if there's a decision that has to be made where the private equity firm has a firm view and they don't want to deviate from that decision, then as the controlling investor, they say, no, this is what we're going to do. Now, it's unusual, but it does happen.
This is where I think the kind of it gets a bit people are a bit wary of private equity because it does kind of come with the connotation of taking over the business and directing it. But so kind of let's put a positive let's expose the positive side of it. Apart from just injecting money, which startups, firms, organizations can get from various sources, what does private equity bring to the company that is of value? It's non-financial, but is of value to the company.
Well, I think the real value so there's two values. If you're a company owner, you have liquidity, which means you get to realize the value of your company by receiving payment. So if it's a family-owned business, the family is not going to be able to pass the company down to the next generation. Providing liquidity and being able to have a way to monetize the business is a big value. Now, what's the value beyond a check? Is it can be financial, it can be operational. A lot of private equity firms would prefer to buy a family-owned business because they think there's lots of opportunity to improve the operation. There's ability to improve the financial management of the business. There's an opportunity to improve the cash flow, opportunity to improve things like working capital. So if you're an owner-operator, these things are important to you, but they may not be the most important thing. And you might be just going day to day trying to deal with customers and suppliers and not paying too much attention to things like cash flow or working capital. Working capital is a big one too. I mean, working capital is usually the amount of money that's tied up with your inventory and your receivables. And so if you're financing your customers and you're not collecting your receivables fast enough, somebody is paying that money, whether you have a line with the bank or it could be your money. So private equity knows how to do a lot of those things. Probably the first thing private equity does if they buy a family-owned business is they hire a CFO that has experience in running businesses efficiently.
When you mention these family-owned businesses, I would expect they are in this middle or lower middle market rather than multi-billion endeavors. You have many years of experience, and now you're operating in this middle or lower middle market. Why there? I guess it's a matter of choice rather than necessity. But the question is, what's so interesting in this market to keep you there?
Well, I think in each segment of the market, there's competition. And if the companies are big enough to hire an investment bank rather than just a business broker, and the larger acquisitions are almost always done through an investment bank. The investment bank runs a process where they try to get as many buyers as possible so that they can realize the highest price. So if there are 30 private equity firms that are looking at a business, and 6 are interested and 3 become finalists, that business will realize the marketplace maximum value because it'll have exposure to 30, 40 different people. Smaller businesses are, the overall dollars are smaller, but the same is true of the returns. So it's a lot of work to run a business that does 50 million in revenue, but it's not 10 times less work than to run one that's 500 million. So it's not so much how much work, it's really around competition and price discovery. I think the smaller businesses have less competition.
I have another question, which one of our first episodes was with gentleman who's been investing in companies himself, and we were discussing about sustainability of operations and importance of sustainability of acquired companies. There is a question, especially I guess for family-owned business, like won't this business be treated like a hot potato, pumped up and sold out for profit as soon as possible, and letting somebody else worry about it? What's your approach to sustainability of operations of the acquired companies?
Well, if you think about the investment in a business, and this kind of takes us to a different subject, but I think one we should cover, which is both the due diligence, but even before due diligence is just the evaluation that you make before you get to a due diligence. Due diligence really only happens with one company. One acquirer does due diligence before they make an acquisition. In the case that I gave, where maybe 60 firms are looking at a business, 6 or 9 will be interested. Those 6 or 9 might spend, tens or 50 hours doing their evaluation on their dime. And then only one will do the due diligence. So the part that I think is important is that evaluation. As a buyer, you're trying to learn as much as you can about the business. And you have access to the owner, typically have a non-disclosure agreement so that they can give you their financial information. You go and visit with the management team, spend a half a day with the management team. And that's where the experience that I have, which is more of an operator than of an investor, has really been valuable. Because when you sit at the table and you meet the CEO, the CFO, head of human resources, the VP of sales, and the VP of operations, and you spend a whole day going through, you maybe tour the facility, you have a whole day.
Apologies.
Where you're spending with the team and you're trying to really figure out, is what they're showing us really a representation of what's happening? Okay. And if you've got a lot of operating experience, you can walk around a facility, whether it be a manufacturing facility or a distribution warehouse, and you can tell by how clean the floor is, how well the aisles are marked, how new the paint on the floor, because typically the floor is painted with, different, don't drive your forklift here. Just looking at those things can give you an indication of what's important to the existing ownership. So you can discover two things. You can discover there's a lot of opportunity to improve this, which is not necessarily a bad thing. And in family-owned businesses,
if it's valued correctly when you buy it.
Correct. And in family-owned businesses, that may not be the most important thing, right? Whether the floors are clean or whether they throw the garbage away more than once a day. But if you've been in a world-class facility, there's no trash. The paint is not worn off. All of the aisles are marked. Every location is marked clearly with professional markers, not a whiteboard that gets erased or a piece of tape with a piece of paper and a handwritten sign. So those are all things that as you're touring a facility and then you sit and spend half a day with the management, those are all clues that you're trying to piece together. And so we ask questions like, when was the last time you had a thorough cleaning? Or tell me how you're going to plan to move this new equipment over here. Take me through the planning of how you move these the product, the raw materials that you receive, to the racks, to the manufacturing facility, to the final goods, and just see how they think about that process. Because there's dozens of books written on all that stuff.
So you mentioned on your in your LinkedIn profile and in some of the posts that we've seen, you mentioned 360-degree diligence. Now, is that exactly what you mean by normally 360 is used in performance reviews when you kind of you get reviewed by your manager, your peers, and your subordinates. What do you mean by 360 in case of due diligence?
Well, in case of due diligence, it's really taking a view from the perspective of the business and looking at all the way around like you would look at the hands on a clock. And so most people want to look at the financial statements, and that's just one piece on the clock. So you have to look at legal, human resources, finance, operations. There's literally, and oftentimes, as you uncover there's the answer to one question brings you to another question, and it might even be in a different category. So I think it's really having a holistic approach where you're not just focused on the financial metrics. Now, the most important thing to most financial buyers is that they're looking at, are the finances what they say they are? So the black and white on a spreadsheet, does it reflect the true nature of the costs and the revenues of the business? But where you're doing due diligence, you want to look at talk to the suppliers, talk to the customers, talk to not just the C-suite, but see if you can talk to human resources, talk to operations, talk to logistics, to see if you're getting the same answers that they've listed in their, because typically there's a presentation that describes all the different parts of the business. You kind of want to verify each of the different parts. I think of it more 360 as you're in the middle of the clock and you're going through all of the different categories that are mentioned in the deck, including the important ones. Now, for financials, private equity will often use consulting firms like the major accounting firm. And those accounting firms will do an entire new balance sheet and profit and loss themselves. And they'll see how close it comes to the one provided by the company. If it's a family business, they might have everything on QuickBooks. And so that's an expensive way to do due diligence. On smaller companies, you probably wouldn't go to that length. But it's not unusual to have an entirely new balance sheet and P&L put together by a third party with the information that they've been given.
So you look at you say you want to look beyond the financials, obviously, because that gives you only one facet of the business. So with my kind of risk manager hat on, my favorite subject, risk management, how do you consider the practices that the business had, the operations around their resilience? And because obviously, if a business is trying to get sold, they want to present themselves from the best possible side. So they will probably also try to get sold at the time when everything is going great, and they will show, now we are in our best shape ever. How do you consider how they're prepared for when the wind turns and they're suddenly, will they withstand any shock in the market?
Well, I think that's a great point. The idea of doing a sensitivity analysis would be part of any due diligence. And back to my position as operator rather than a financial manager. I mean, I've worked with some great CFOs and great VPs of finance who've taught me a whole slew of very important lessons. And so you have to rely on them. But you're right, Artur, the position that the company, and if they hire a bank or even a broker, they're trying to show it's never been better. This is the best time. We grew a lot the last 3 years, and we're going to grow 3 more years at the same rate. So you basically have to make your own assumption. And if you're buying a business where you're going to have some amount of debt, you have to be sure that you have enough room, because with the debt holder, typically, a bank, or there's lots of alternative investments now, which effectively private equity firms that are providing credit, they have a first right to the business. And so if you break the covenants of your credit agreement, they could take the company over. So if you're making an acquisition and you're using a lot of leverage, you have 30, 40, or 50% debt, you have to be very careful, because you're basically risking your investment if the business would ever get in a position where the creditors could take it over. But think about it. You're the one proposing the amount of debt. So you have to have the amount of debt, have enough flexibility to withstand a big downturn. And for those of us who've been through 2009 and 10, 2000, 2001, these were significant downturns. And then clearly I think using the pandemic as an example is difficult, because there was a government bailout effectively where companies were able to get PPP money to keep them afloat. So that was a bit artificial. But the real, economic downturns of 2000, I'm just going in my experience, 2000, 2001, which I think for the business I was involved in at the time was 20 or 22%, which is catastrophic. I mean, A lot of businesses can't withstand a 22% revenue decline. You can't cut your expenses fast enough. And then the financial crisis in 2009 and 2010, nobody trusted anybody. So anybody who had an outstanding debt was not going to be happy to renegotiate credit, which is usually what happens. Mm-hmm. Right? If you break a covenant with most banks or lenders, all they do is charge you a fee, redo the loan, extend it, potentially charge you more interest. And so if you're an investor, that just means you've made less money in this investment. So
absolutely,
the credit analysis, this is where actually private equity earns their money, because that part of the business, right, the financial management, how much leverage can a business carry, is a very important question. So to your question, how do you determine how well the company will do if there's a downturn? Now, you can't really spend a lot of time thinking, how well will we do if they're not telling us the truth? Because you'll uncover that in due diligence. It's really if the market turns against you, then, and so for somebody who does risk analysis, we're just looking at different models, different financial models that says if the revenue declines at this level over this period of time, we will have to reduce expenses this much, which is reasonable. If we have to reduce expenses, X plus Y, is the business going to be able to recover? And do you have to cut so much that you don't have enough salespeople or enough operational support, and you can't support your customers when they come back? So there's a real balance between making sure that you have enough room. And in private equity, nobody likes to go in and make less money in a year because your sales have declined. But you want to be able to keep the business in a way that as the demand comes back, you can take advantage of the marketplace without having to hire and train people, which is expensive and takes a lot of time.
But I want to challenge you here a bit, because again, this is looking at a company from a very financial centric point of view. What about kind of stepping back and looking at the operation and looking at how the company, whether the company will be able to actually prevent the decline in sales or the losses, the operational losses? Because if the sales decline, that means that an event has already happened, and you're looking whether the kind of the organism will still survive once it's been wounded. But what about the resilience of a company to actually prevent the wound? And in case of disruption of, for example, supply chains, having a supply chain that's resilient enough such that when a disruption happens externally, it's diversified enough that the company doesn't actually suffer.
So I would divide our conversation into two parts. So the part that I just described is really purely financial. Like everything that's happening is on a spreadsheet. You're changing the numbers and you're seeing what happens as the numbers go down. You're seeing how much you have to manage expenses to try to maintain your leverage covenants. So this is all purely financial. When I would meet with the CFO, we would sit and we would talk, looking at a piece of paper or looking at a computer screen, and we would just go over and over all these different variables that are, okay, what happens if we change this? What if we change this? What if this goes to this? How many people would it be if we had to reduce expenses this much? What do we spend on this? And so this was all just on paper.
And that's where our interest jumps in, because we are the operations guys. In our work, we work with operations and we model processes. So my question, jumping from this financial part that you said into operations part, where you're experienced and as you describe yourself an operator, is how do you model? Like you said, okay, so let's assume that we can cut costs by X amount. how do you translate it to operations? Because it's easy to say, oh, let's cut the cost by 50%. We know some amazing business people who say, let's take a big company, cut the cost by half. Let's fire half of the people randomly, almost. So how do you decide how much you can save on sales without, as you said, getting into the trouble when the market bounces, but how much you can actually save on I don't know, delivery, manufacturing, or whatever.
So let's think about two people in an office looking at a computer screen, talking about numbers and doing an analysis that based on variables, where you're just changing numbers on a spreadsheet. Mm-hmm. Now open the lens up to a meeting where you're sitting across the table from individuals where each person has a role with each of these different lines. Mm-hmm. Right? Artur, you talked about supply chain. So yep. if we're doing a management evaluation, we want to hear from the owners of each of these categories: operations, running a facility, procurement, managing the supply chain, logistics, having the goods travel either on the water, on a train, on a truck, to either to your facility or to your customer. And then what's the leadership of the CEO and the CFO? Because if you're just looking at the piece of paper, you're missing the people that have to help you implement those decisions. And this is actually a big part of leadership and trying to evaluate talent. As a CEO, I tried to never say, you're going to do this, you're going to do this, you have to do this, and you have to do this. And then each of the people that I'm talking to is going to do the numbers that we changed on the spreadsheet, right? What I would much rather do is have them have an understanding of what their part of the whole is and how important it is and how they are responsible for managing their piece. So there's a constant friction between operations and sales, right? Operations says, we have capacity. We could make more money if we had more orders. And sales says, well, we need some customization for our products, for our customers. Otherwise, they won't buy it. And operations says, well, if we customize, then the lead time gets longer. So there's a little built-in friction. The biggest friction between operations and sales is when there's not enough demand, right? Because operations doesn't go out and talk to the customers and generate more demand. And so the evaluation that you can do in a half of a day doesn't really get you the answers that you need, but it can give you a clue. It can give you, do I trust this person? If I was sitting in a board meeting with this person and they were telling me, we've noticed that our sales forecast has slowed down, therefore we've decided to hold off on some of our discretionary expenses. Then the operations person says, we've agreed no more overtime unless there's a particular customer that requires it. And so we're going to cut back on our operational expenses. And you see that people are working together. That it's the people that are responsible for the numbers, right? Not the two financial guys sitting in an office looking at a spreadsheet. Mm-hmm. So I think that point of the evaluation, especially if you're going to own a business, where, and my background is sales and marketing, so I like to really ask a lot of sales related questions. Tell me about your sales reps. Tell me about your comp plan. Tell me about what your next sales opportunity growth is. Like, what's the easiest one? What's the best return with the least amount of money? What's the one that you would like to do, but you have other things ahead of it? And just kind of let that person answer those questions. Because to me, what you're buying are the people. You're not buying the spreadsheet. You're buying the people.
We worked on some mergers and acquisitions, and we've been told that our role is to check how many people will remain, because if the big company is buying a smaller one, there is a culture shift, and it was also for us pretty obvious that what we are supposed to do is to retain the talent, because the company without, okay, some companies you buy for patents, okay, but we are talking about buying the operating business. Retaining this is critical. I have a really quick question. Let's say some of our listeners, maybe they are thinking of being, bought by PE, and would like to understand a bit better this 360 due diligence, the way that you do it. So if there is an interested buyer and he wants to really learn about the company, how long does it take? Such a process, the due diligence in this case.
Okay, so just to be clear, due diligence is during the time that you have an accepted offer and you have exclusivity to negotiate. So there's just one. There's just one company doing due diligence.
Yep.
Usually, well, how much time it takes is usually not up to either party. It's oftentimes dictated by the banker or the broker, because the less time, the better. If it's the seller or the broker, and the more time, the better if it's the buyer. So typically, it's between 8 and 12 weeks.
All right.
Reasonable amount of time, and obviously there is kind of this. There's a lot of dynamic during the due diligence. The buyer wants to find out, as much as possible. The seller wants to show themselves in the best light. But so again, I would ask about the operational aspect, because you say you buy the people, right? But the one of the goals, for example, of our consulting practice is to separate a bit the people, or the persons, from the operation, such that the business can run with, the processes can run with almost any people of sufficient experience and knowledge, such that the business doesn't rely on a specific person. There's no key man risk, as is usually called in the operation. So do you see that key man risk as a problem in your when you do due diligence? Have you seen companies that have key man risk, and how do you go about removing it?
I think the biggest key man risk issue is if you're buying a family business that's been run by the founder. Usually, that person has all of the decision making. Usually, they usually have most, if not all, of the financial decision making. They sign the checks, they approve invoices. So, oftentimes, if you're buying a family business, the founder will stay for a year to 2 years. If you're buying a family business as private equity, oftentimes you want the founder to invest with you, so that they only sell 80% of the company and they keep 20%, 15%. And then they get to invest with you, so that in 5 or 6 years' time, when the company is sold again, they get the benefits of the private equity improvements. So if you have that dynamic, you've offset your key man risk, because now your key man is your partner too. And you may have a plan where you say to the founder, we're going to hire a CFO. That's going to happen in the first 2 months. No debate, right? We're not going to give you a vote on that one. But we'll say, and if you want to retire, or even if you don't want to retire, we're going to hire a professional manager to come in and train with you for X. Sometimes it's only a matter of a couple of weeks. But what you want to do is you want to outline how that person is going to transition, so that they have no incentive to leave, and that they have all the incentive to help give as much information as possible to minimize any key man risk. So that would be a dynamic where you have them locked up through an investment side by side. Mm-hmm. If not, you have to be ready the first month to bring in a replacement. In some cases, the founder doesn't want to stay more than 30, 60, 90 days. And so it's part of the metric of how much risk do you have of things falling apart. So if you have a CFO, typically, and what many private equity firms just want to make sure there's continuity of that you're collecting your receivables. Typically, sales are harder to slow down quickly, right? Like usually a business is generating sales. If the sales cycle is more than a few weeks, the next few months of sales are already coming. So you have a little bit of a window. The next level of risk is really around customers. And I think that's part of the evaluation is how sticky are the customers? Here's one that we really like to look at. And this is why a software business is valued at 12 or 15 or 18 times its EBITDA, whereas a distribution business might be 5 or 6 or 7 times. So in a software business model, I'm selling a license. And once you have my license, you pay me quarterly, monthly, annually, but I don't have to sell you again to get your revenue. So the recurring revenue from software is very sticky. If I wake up January 1, I can tell you December 31st how much revenue I'm going to get from my customers. And then everything on top of that is the new revenue that we want to generate. If I have a distribution business where I have 800, 1,000 customers, and my biggest customer changes year after year, and I know I'll have a big customer, I don't know which one it's going to be every year, there's more risk in that business. Because if one customer goes to a different distributor and you've lost 5 or 10% of your business, it's hard to make it up. So you have to look at who your customer is. What's the typical sales cycle? How close are the salespeople to the customers? Is it the salesperson's account or is it the company's account? If the salesperson were to leave, could they bring that account to a different distributor? Or if they leave, they continue to buy from you because the product is one of a kind. So think of all of the variables around the customer and how much risk you have to try to measure. And so that's where from an operational experience, and when I say operating, I don't mean running the facility of a manufacturing or distribution facility. I mean the day-to-day managing of of who your customers are, how you get new customers, how hard it is to keep your existing customers, how easy it is for them to leave. All of those things go into measuring the value of a business.
I guess it's one of the reasons again why software is a bit easier or stable. If you change your software, you have a lot of processes to change usually as well. If you have a distribution, there is a truck coming with some goods. I don't care where did it come from.
Yeah, and our listeners will know that Marian has a very kind of low view of software developers, and that they're not doing anything complicated, right, Marian? So,
absolutely,
that's kind of a running theme through some of the discussions that we've had. But I want to ask you about now. We've spoken about the kind of the measurement of the company when it's being considered for acquisition or acquired. But then the goal usually is to make the business work and make it work better and grow, right? So how do you kind of check whether there is scalability in the business? In your experience, if you have two companies, they both look great currently, but are you able to tell the difference between a company that just will stay the same for the next, eons versus a company that can just easily scale to 10 times, 20 times the size that it is now?
And so that has a lot to do with the sales channel. And so that's where somebody who has a lot of experience with managing sales channels and managing sales managers and really talking about who is the customer? How do you get to the customer? How do you influence the customer? How does the customer view your company? Like those are critical questions to answer. And those will answer a lot of the scalability questions. If the sales cycle is person to person, if it takes a long time, it's very difficult to scale that business more than you can add salespeople, have them make sales calls, get them in front of customers that are potential customers. And then in X, it could be 3 or 6 months, you make a sale. So scaling that business 10 times is next to impossible. So a business like that, you're saying, well, how can I make it more efficient? How can I make the processes that we do? And do we have too much customization, which extends the selling cycle? Do we have too much expense before we make a sale? Do we have after sales expenses? So those are all things that you evaluate. And frankly, most professional people who are looking at evaluating companies will be able to say, you can't scale this business very easily. The sales cycle is long, just for the things I listed. There are things you can do, however. You can think about, do we have geographic expansion capability? How much does it cost to get into a new geography? Does the company have examples of geographic expansion where they move into a new market, they hire salespeople, they eventually open a small office? Do you need to open an office? The other piece would be, are you covering all of the different markets that could be applicable for your products? And so I would say that the biggest scalability questions are, do you have geographic opportunity? And do you have vertical market opportunity? So if you're selling construction products, do you sell also to hotels, restaurants, hospitals, and schools? Because a lot of those particular vertical markets have different categories, even within general construction. I mean, I'm not talking about cement or plywood, but wall covering in hospitals is specific to hospitals. Flooring in hospitals is specific because they're focused on bacteria and health issues. Even the linen and the bedding in hospitals is different. Hospitality has different requirements from commercial, different from residential. If you're going to change your hotel room every 5 years, your investment in finishes in that hotel room are different than if you're going to build an office with a 20-year lease. So vertical markets and geographic expansion. And then if you can't make the business dramatically more efficient, like that's your evaluation, right? I can't make a cycle which is 6 months for a sales cycle into an online sale where I get a sale every day. It's just the two things are incompatible.
Yeah.
So then you're just trying to professionalize the business. Do we have good processes for procurement? Do we have good processes for vendor management? Do we have good processes for receiving and deliveries? Do we have a higher than normal expense rate for freight damage? All of those things have to do with how efficient you are and typically how well your processes are. Because if you have good repeatable processes, you're measuring things like freight damage and you're addressing them when they go above a certain.
So I think this.
I was just going to say, that's typically not the level of detail you get at a family-run business. They're not measuring what their freight expense for damage is. They're not measuring what their warranty expense is. They're not looking at things like working capital by having too much inventory, because they buy a bunch from their friend every quarter, and then they have 6 months worth. And at the end of the year, they have $500,000 of this unfinished product or product that won't be sold for months tied up on a shelf rather than in the bank.
It kind of depends whether it's a successful family-run business or one that's kind of barely getting by day to day.
But the barely getting business probably doesn't grab much in the attention from PE.
Well, from what we hear, maybe it should, because there's plenty of opportunity to improve, right? So to grow.
I would say that think about that. Think of the private equity firms as colors on the rainbow or flavors, because each of them have their own idea of what the perfect company is for them. And for some people, the perfect company is a total mess where there's nothing but 100 things to fix because they've done it before. They know the top 10 places to go. They can fix things efficiently because they've done it before. Then there's the firms where they say, we want one that's already fixed up because we're going to put 2 or 3 together, and our strength is integration. Then there's one that says, this company has done all the geographic expansion in this one market. We're good at getting into the other market. So those different flavors usually are based on experience. And so there's really, and I think when we talked earlier, there's no one type of private equity firm. There's no one type of company that a private equity firm likes to buy. It really has to be the match between what a company has and what the private equity firm is looking for.
It is a nice cycle that we made here, because we asked you in the beginning, like, what you should expect from private equity except from the check. And what you're describing now is exactly like, you can expect the help in expanding into new geographical markets. You can expect help with integrating with other, creating this maybe vertically integrated businesses. We work with that as well. So this is now it I think opens up the possibilities. It's not just a grumpy guy with the checkbook that says, okay, this is your money and please bring me more in a week, or I will break your legs.
But it also no, not that. But there's also, I think, another conclusion which can be drawn here, because the audience of our podcast is mainly business owners and managers. It's not PE people specifically. And I think for them, the practical takeaway will be that if they want to sell their company to private equity, they want to attract the investment, they need to find that match that you're speaking about. They need to find a company that will respond to the particular conditions they are in, whether they have opportunities for expansion or for different markets, for vertical integration. They need to find a company that is looking for specifically that characteristic and highlight it in their interactions, in their materials, because that will be the selling point, the appeal, right?
I think that makes perfect sense. And if you're a sophisticated business owner, you own a business, you're thinking about selling it, I think you want to highlight what the strengths of your company, what the strengths are, but you also want to highlight what you haven't been able to do and what you think the company could become. And in some cases, the company can't become what you want it to do because of your shortcomings. And so I would say the best seller is going to say, I wish we could get into international. I think there's huge demand. From the time I've traveled, there's opportunity. I just don't know how to do it. I don't have the time. I don't have the bandwidth. And so that sends a signal that you've already thought about it. Here's a management tool that I like to use. This is with all of the teams when we're trying to figure out projects that we're working on that are outside of just kind of what we do all day, every day. Typically, trying to do continuous improvement. I'd say, I want you to have a list of 10 projects. Okay, you always should have a list, 10, maybe it's 5, 6. We only can do the top 1 or 2. But that doesn't mean 3, 4, 5, and 6 are not important. And that doesn't mean that next year, number 6 doesn't move to number 1. But we always want to be looking at what are all the things that we could be doing. And so if you have a list like that, if you're a business owner and you have a list of all the things you'd like to do, and you might be embarrassed because you've only been able to do 1 or 2, if you worked for me, I would only allow you to do 1 or 2, right? And until the 1 or 2 is complete, you can't move on the list. But it's important to have that list. Now, I wish this was my idea. This was taught to me a long time ago by a CEO who said, we can only do 2 or 3 things at a time, but we want to have 10, so we make sure we're doing the right 2 or 3.
Absolutely. That makes perfect sense. I think we've reached a very nice closing point, because we've spoken about all the characteristics of a company that private equity is interested in, and how to actually look at the company and what companies can do to be more attractive. The company that you're involved with, it's
WoodLake.
Sorry, WoodLake. Yes, sorry, it just escaped my memory. So WoodLake is obviously there are links online on your LinkedIn profile as well. Are there any other kind of ways that you would recommend people reach you if they want more information?
Before we jump into links, what is the flavor of what you do right now? Like, what are the companies that you would like to attract?
Okay, we look for family-owned businesses, not private equity-owned, and that's an obvious flavor, because private equity has usually professionalized and created value or taken cost and inefficiency out of a business. Mm-hmm. So family-owned is a big one. Industrial is another one, mm-hmm. because there's less competition around industrial. High margins, which
everybody loves high margins.
Well, but some people are happy with lower margin business because they think that they can improve them. For us, it's just like something Artur would say: higher margin business gives you more margin for error, and so more room. Absolutely. But it also may mean that the business is run very tight. Think about mm-hmm. it, right? I could have a very high margin business because I'm keeping it only in 3 states, where I can control everything. I can see what happens every week, mm-hmm. visit customers, and I might be making a lot of money in 3 states. Mm-hmm. So that business might have easy geographic expansion that the founder might not be interested in doing, because he had a $40 million business that was earning $8 or $9 million. But if you could have a $100 million business in 3 or 4 years, and you could earn $16 or $17 million, that's a dramatic increase. And the only difference might be geography.
All right. Sounds perfect.
So that's our flavor. We try to keep and small, where there's less competition.
Absolutely, right. the lower middle market. So we'll post links to your to WoodLake in the description to the episode, so people can find out more and
And my LinkedIn profile.
Your LinkedIn profile.
Yep. I think that's
anything else you would like to us to share with our audience?
I think those 2 are going to be sufficient.
All right.
Great. So thank you very much for sharing this with us. I'm sure our audience will have quite a lot to digest from this episode, because there was quite a lot of information. And as usual, we hope it was of use to someone.
Thank you for listening.
You can find out more about WoodLake Group at woodlake-group.com. As usual, all links to the references will be available in the notes to this episode.
Also, don't miss the next one, where we'll be talking to James E. Miller II, businessman with an extensive C-suite experience, founder and CEO of the Vision Investment Group, about creating, communicating, and implementing a business vision.
Subscribe on your favorite podcast platform or visit bdr.show to find out more about future episodes and guests. You can also check out cognition.llc for more information on Cognition Shared Solutions, our services, and other events hosted by us.
For now, it's thank you from myself, your friendly neighborhood data guy, Dr. Marian, and my co-host, Artur.
Thank you.